everybody. Thank you for joining us today, and we apologize for the few minute delay that we have going on here. I want to go ahead and introduce Beanna, and we'll go ahead and get started real quick before we do that. As we always do with the beginning of the webinars, we let everybody know that should something happen in the middle of the webinar and you need to drop out, or if you need to go back and see another slide some other time. We do have this presentation being recorded, and we will have that available to you after today's presentation. So if you need to drop out, we can make sure we get that recording to you, as well as any handouts from today's presentation. Beanna Whitlock is on the line today, and she is joining us for tax planning for seniors. Beanna, let's go ahead and get started. Thank you so much for joining us.
Great, and thank you, Erica, for arranging this today. I'm very pleased to be with my CSAs, or my fellow CSAs, on tax planning for seniors. I've been out across the country teaching tax professionals how to get ready for this filing season, and it's my pleasure to really concentrate on some of the specialty issues that seniors are involved with. I hope you are seeing the PowerPoints, because I do think it will help in a visual presentation for today. On the first slide, working with the senior client, seniors do have unique tax issues. We'll talk about several of them today. And although this is not as in-depth in the mechanics of preparation as I teach with tax professionals, it is extremely important that CSAs understand that almost everything their senior does will have a tax impact. The latest statistics we have show that 25% of all individuals age 85 and older are in nursing homes. Now, that in itself is a tremendous realization that our seniors are normally at age 85 and older in failing health or not able to care for themselves, which brings in a whole new element of tax planning for our seniors. Nearly as many of these individuals receive assistance in their own homes. So whether they are in a care facility or they are in their home setting, the issues having to do with their health will be a tremendous issue as far as moving forward into medical deductions for our seniors. Unique tax planning challenges. We know that many of our seniors, and a senior defined as being someone who's age 65 and older, are afforded government programs such as Social Security, Medicare, and Medicaid. In the new Affordable Health Care Act, there are changes, and many of our seniors who otherwise would not be on Medicaid because they made too much money or income may be available to move into Medicaid with the increase in the ability to make income in many of these states. Again, you have to be aware in your home state what these rules for Medicaid participation are. We know our seniors have many medical and medically related tax issues. As seniors increase in population, and they are increasing in the United States at about 10,000 a day. That's every day. That's 365 days a year. 10,000 people are turning age 65. We are the fastest growing age group in the country, and we know that seniors will dominate the national budget as far as Social Security, Medicare, and Medicaid are concerned. Decisions and challenges during the last decade of their lives will require trained CSAs to help them with those decision-making capabilities. Your practice pointer says since family sizes have shrunk and family members live further apart, the tradition of taking care of seniors has diminished. Many of us who are older remember caring for a mother, a father, a grandparent in our home. It even extended to aunts and uncles, or perhaps someone who was disabled in the family. They lived with other family members. That is no longer part of the culture of the current United States. Tax professionals and with the assistance of their CSA, must assist and advise senior clients. That oftentimes includes expanding that assisting and advising to the families of those seniors, providing for retirement, long-term care, and estate issues for our seniors. They may not be able to continue their current lifestyle, and that is a very sensitive subject to many seniors who planned on a certain lifestyle after retirement, but because they continue to live longer, then they may have to adjust how they planned on living in their senior lives in order that they can continue to live well all of their senior life. Understanding and serving that senior client begins with understanding their physical limitations, their psychological makeup, their fears, and their desires. And understanding each and every one of those is primarily the responsibility of the CSA. The CSA needs to identify clients who need planning, assistance, and tax advice. Rarely do clients plan to protect their assets from a medical emergency. And I love to use this phrase because it resonates in the senior community. Failing to plan is planning to fail. And they will not want to do that. They won't want to sit down oftentimes and plan what they need to do. But tell them that if they fail to plan, they are literally failing in their plan, and they need to make those decisions. How can we identify our clients that need tax and financial help? Well, there's a wonderful document called their tax return, and it tells a wonderful story about your taxpayer or your client. If, in fact, on Schedule A, itemized deductions, there are large medical expenses, then oftentimes once a senior travels into that world of needing medical care, that medical care will continue, that need for that care. The condition that they have that requires the medical care may worsen, and so there may be even more of those medical deductions. Form 1099s that come from banks, come from brokerage houses, may show interest earnings, dividends, and capital gains. Those would be reported on Schedule B and Schedule D of that taxpayer's tax return. That would indicate to us that there would be substantial assets that your senior would maybe have at jeopardy should they have a medical emergency. Even the address of their property where they live. If it is in a higher income or higher net worth area of their community, could indicate that we should identify this client as one that needs some tax planning advice. These are all keys to wealth, and once you have wealth, that wealth for the senior is subject to loss. How do you advise those seniors? Working with your tax professional, you know that a traditional way is to look at their last will and testament. If you are only looking at the area of what will they have left to give as an inheritance to the people that they care for. However, because their lives may live longer, their lives may be extended, we know that there will be additional cost to maintain their lives. Therefore, there may be no inheritance at all at the time of their death. Estate plans can provide planning as well. However, with the cost of living continuing to increase, there may be a better way to protect the senior's assets, yet give the senior some income to live on. One of the issues we want to discuss today is DDI, death, disability, and incompetence. We understand as CSAs that incompetence is in the area of not being able to make a legal decision. Money used as a measure of love, power, or control are emotional topics. And one of the things about our seniors is that they are more emotional than they were when they were younger. In evidence, estate or long-term care planning results can be unpredictable. So we have to continuously stay in tune with what is happening physically and emotionally and mentally with our seniors in order to help them determine what they want to do with an inheritance, what to do with their estate. However, children may want something different than the senior, and working with the family may put you somewhere in a compromising position, and we will talk about that compromising position a little later on. Now, asset protection planning begins with gifting. The amount a senior or anyone can gift to any individual in 2013 is $14,000. If that senior wishes to gift more to that individual, they would be required to file a gift tax return, which is a Form 709. That form must be filed, and either the giver, who would be the senior, pays the tax on the gift, or they use part of their lifetime exception. In 2013, that lifetime exception is $5.25 million. So for all but your extremely wealthy seniors, that 5.25 exclusion from gifting for their lifetime will be more than sufficient for the senior not to pay the tax. But they must file the Form 709, which is a gift tax return. Additionally, in asset protection planning, transferring the bulk of assets into an irrevocable living trust could be your answer. Now, bear in mind, the most important word in this phrase is irrevocable. Irrevocable meaning that it cannot be changed. The senior has no control of their assets anymore, which may be the strongest fight against this by your senior. But they do have the right to receive all income that's generated by their assets, which would be their pensions, their Social Security, their interest income from the bank, their dividends from their stock, all flows through that trust to the senior, and the senior gets that money to live on. The issue, however, is the senior is only the beneficiary of the trust. They are not the owner of the assets any longer. They have placed those assets in an irrevocable trust that cannot change. Now, when your senior passes away, when they die, the trust does not die. Only the beneficiary of that trust changes. So your senior, who intended to give all of his or her assets to their children, can still do so, but they do it through the trust because the trust is a protective tool for those assets. And now, at the death of your senior, the senior's children become the beneficiaries. That's the way it works. You can also have the senior give away the home with a life estate. Now, very briefly with this, that is when the senior wants to put their child's name on the title of the home. Now, first of all, that constitutes a gift. The home has now been gifted to the child. But the senior wants to continue to live in the home. The senior then will have concerns. There will be differing opinions between what the senior wants and what the children want. The children want mom to give them everything, and the key phrase that's used, all you have to do is trust us. Don't you trust us, mom or dad? But mom is afraid of getting kicked out of the house. If she puts the child's name on the home, then the home belongs to the child, and the child can sell that house. unless a life estate is retained. We'll come back to that. The tax professional may say, I can protect your assets if you listen to me. However, do not listen to me, and something is going to happen. Either the IRS is going to get your assets, a nursing home is going to get them, or there can be some other unforeseen threat. Who is the senior to believe? And oftentimes it will create a situation where the CSA will have to intervene and help the senior make the decision. The tax professional, however, is to assure the client, answering questions about the loss of principal if they gift, which may diminish their income. I'm oftentimes amused here at the end of the year. I will, as a tax professional, get calls from my clients who say, my nephew called today and said I could gift him $14,000. How much will that save me on my taxes? And I have to explain to the senior that that does not save them anything on their taxes. What it might do, however, is diminish the corpus of their assets where they may not earn as much in interest next year or dividends if they have to sell stock to come up with the $14,000. And that's my role, not to tell the senior whether or not they should make that contribution, but indeed that if they want to gift to their nephew $14,000, what the tax impact, what the financial impact to them would be. Understanding the state of mind of the senior, the tax professional should do a cash flow analysis to look at the income and how sufficient it is. If the senior has more than sufficient income coming in, that they're not using all they have in order to live, they're not reaching into the corpus of their assets in order to sustain their lifestyle, then perhaps gifting is okay. However, if they're going to gift, they have to make certain that their gift today does not harm them financially tomorrow. And then it's always wise, if the senior is considering gifting other than cash, I'm talking about stocks, bonds, property, then the senior should be talked to about the difference between estate tax and gifting. In the world of gifting, if you have a piece of property that you bought 40 years ago for $100,000 and it's worth $1 million today, you are gifting to your nephew $1 million, which you either have to pay the taxes on or you will in fact reduce your lifetime gift of $5.25 million. If you do that and you use that lifetime gift, then when you die, all you have is the difference between the 5.25 and the $1 million that you gave your nephew, or 4.25 in an exception for the estate. So it's a reduction of the amount of your estate that is not taxable if you in fact use that as not paying gift tax on gifts during your lifetime. The second issue is, when you gifted that $1 million property to that nephew, you only passed through to him a basis of the $100,000 you had in the property. So if he were to sell that property after the gift, he's going to have to pay taxes on $900,000, because when you gift, you only gift your basis, although the value of your gift reduces your lifetime exception of gifts. If you wait until your death and the nephew inherits that land or that property, then he inherits at fair market value, which means there is a step up in value as of the date of death. If the value of the property was $1 million at the date of your death and your nephew were to sell it the next day, he would not pay any tax on it because the value of the property at the date of death becomes his basis. You might want to gift now. Beneficiaries would be able to use your gifts now, and in fact, you would have the great pleasure of seeing those gifts being used by your beneficiaries. As an example of that, I can tell you that when my mother passed away, she left my sister and I a very nice inheritance. My sister has decided that she will pass that inheritance on to her children when she dies. I, on the other hand, use that inheritance every Christmas, and my 2 adult daughters and their spouses travel for holiday with me and my husband. I get to see them enjoy my mother's inheritance, and I get to pass that through to them through that gift each and every year. The tax professional should also explain that even if that senior gives that $14,000 to that nephew this year, that in no way commits them to giving those gifts into the future. You take 1 year at a time because the circumstances of the senior may definitely change from year to year. In the world of long-term care insurance, it is the CSA, the tax professional, and the financial advisor that work together to prepare projections on the cost of nursing home care versus the cost of insurance. We know that long-term care insurance does not keep you from getting old. What it does is it reduces the burden of costs on your senior, whatever form of long-term care that they need and desire. They should have those choices explained to them, and being in control of their senior lives keeps them from being dependent upon Medicaid and Medicaid changes that will be coming to them. In your practice pointer, the primary goal, and that is of the tax professional, the CSA, is to reassure senior clients that preparing for a crisis is wise and beneficial to all parties, while at the same time reassuring them that no one is trying to rob them of either their money or their independence. That's why it is their decision to be made. And that's why it's important that they understand what decision. Remind them again that failure to plan is planning to fail. Now, in your world of CSA, the pointers I have for you are to remember that you've got some people on your team, your certified financial planners, your estate planning attorneys, and your tax professionals. They should all be working together with you as the centerpiece for that senior, remembering that all financial decisions ultimately result in a tax implication. That's why today we're talking about the tax professionals and how you can interact with them. Tax professionals can offer a myriad of services to your seniors. Of course, right now we're thinking about tax planning, but retirement planning, pension and IRA distributions before and after death, protecting their assets, which would work into the estate plan, nursing home planning, Social Security tax and benefit management, estate planning, and a host of everything in between. So I urge you not to just think about the tax professional and your senior during January through April 15th, but to keep them in mind all year long because they know the impact of those financial decisions on the taxes of your taxpayer. Now, particularly taxing issues for the senior client, that's what we're here to talk about today. We know that our seniors in their retirement years will likely have less earned income than they had in their working years. Earned income is a term that means this is the income that senior earned because they physically went out and did the work. Their earned income. This is different than dividend and interest income. The senior doesn't work for that money. Their money works for that money. More dividends and interest will be coming in to our seniors, and they will have fewer itemized deductions. We will find that most of the time our seniors because they do not have mortgage interest on their home, will in fact no longer be able to itemize their deductions on Schedule A of their federal income tax return, but indeed will take the standard deduction, or what the government allows them, and we'll get to that. There is some special treatment for our seniors for tax purposes. They can make more money and not have to file a federal income tax return. Seniors must be age 65 or older at the end of the year to receive an additional standard deduction, which for a married couple would be $1,200 each, or a total of $2,400, and $1,500 if that was a single individual. There are also some credits, credit for the elderly or the disabled, and those are for our special lower income seniors. Now, the first question I normally get from my senior taxpayers during the filing season is, did I make enough money that I have to file a tax return? Now, minimum gross income may be too low to file, and that minimum gross income is never from self-employment, because self-employment income usually has an additional tax that comes with it, which would be self-employment tax, or twice the FICA and Medicare tax that would come normally out of a W-2. With the additional standard deduction for those age 65 or older, there may be insufficient income to file, and the taxpayers or your senior would not have to file a tax return. The only reason then that they would file would be to receive any withholding they paid in back, such as an estimated tax payment, or if any credit was due to come to them. An exemption from withholding can be made, however. So if your senior continues to work, they can file an exemption with their employer where no withholding would be taken out. Income insufficient to file is different for joint taxpayers, that would be married couple, or single taxpayers. The standard deduction in 2013 for joint couple is $12,200, and for a single individual would be $6,100, or one half of that. Now, these amounts continue to increase each and every year. They're indexed with inflation, so there's usually a very small increase. A personal exemption for a married couple would be $7,800, and for that single would be $3,900, or one half of that. What that means is each individual on that return is afforded a personal exemption, and the personal exemption amount for 2013 is $3,900. However, if your senior is age 65 or older, or they are blind, then for a couple filing a joint return and they are age 65, that would be an additional $2,400 or $1,200 each added to their standard deduction. For an individual who is a single filer, they get a little bit more. Instead of the $1,200, it's $1,500. So your grand totals for married filing joint taxpayers who are age 65 or older would be $22,400, and for a single filer, $11,500. If that is all they made in whatever source of income, except for self-employment income, they would not be required to file a tax return unless they had paid in some withholding, either through their paycheck or through estimated tax payments, or they were entitled to a credit. Again, both taxpayers age 65 would get an additional blind exemption, if they were blind, of an additional $1,200. For your single taxpayers, that $1,200 turns to $1,500, age 65 and older, or they're blind. The definition of blind is 200 in the best of their eyes. Once the taxpayer is deemed to be blind for federal tax purposes, then with the first return claiming that blindness, the doctor's diagnosis goes in with the tax return, After that, no further requirement. If your senior is incapable of filing their tax return, if they can't sign that return, they're sick or disabled and unable to conduct their own affairs, the tax return for that senior may be filed by a duly authorized agent, guardian, fiduciary, or other person charged with the care of the individual or his or her property. If the senior is unable to sign due to illness or injury, and their spouse is available to sign, the spouse can sign that tax return if oral consent has been given, and a statement acknowledging that oral consent was given has to be attached to the tax return regarding the taxpayer's inability to sign. Oftentimes, our senior taxpayers can have dependents on their tax return, and that dependency exemption, again, would give that senior an additional $3,900 for every dependent on their tax return. Now, it can be a qualifying child, it can be a qualifying relative. However, in the qualifying child world, we look at the relationship between the taxpayer and that qualifying child, the age of the child, the citizenship or where they live, the principal residence, and maintain that the child is not self-supporting, meaning the child cannot support themselves greater than 51%. Qualifying relatives are anyone who meets these 5 tests. Again, the relationship, age, citizenship or residency, principal residence, and they too are not self-supporting. It includes a child that does not meet the qualifying child due to age. They are in fact too old to be a child anymore. Member of a household must be for the entire year, other than if it's your spouse. And the supporting test, earnings, does not apply for a child, but does apply for a qualifying relative. For a qualifying relative, to claim them as a dependent on your tax return, that qualifying relative cannot have income in excess of $3,900. That's the personal exemption amount. If this is your own child that you are claiming as a dependent, there is no income limitation, other than the child cannot support themselves greater than 50%. But on the qualifying relative cannot make $3,900 or more. This is more the instance we're going to encounter. It's called a multiple support agreement. No one person contributes more than half the support. It's for mom. A Form 2120 is used. It's called a multiple support declaration. And anyone that has supported mom more than 10% has to sign the form that in fact is going in the person's return that is going to claim mom as a dependent this year. They each then declare that they are not going to claim mom. Under the 2120, claiming dependent age 65 and older, those do not get an additional standard deduction. So if someone else is claiming you or claiming mom, she does not get that additional standard deduction of that $1,500. Your example is a good one. Alice is a widow. She lives in an assisted living complex. Of the $2,500 monthly support, she receives $1,000 from Social Security. She has 3 sons, and each one of them provides $500 a month. That means $1,500 is being supported by the sons. And that $1,500 is more than half of her support of the $2,500. Any one of those 3 sons can claim Alice as a dependent using the Form 2120. But the other 2 sons must sign off on the 2120 saying they are not going to claim her. Now, the sons can change from year to year. Mo can claim her the first year, Larry can claim her the next year, and Curly can claim her the next year. They can divide off but only one can claim their mother for the year. We know that there's an additional claiming benefit. If you have claimed mom as a dependent, you may be able to claim that child and dependent care credit if the cost paid for that disabled dependent so that you can work, look for work, or go to school. To be eligible to claim the credit, the parent must be incapable either physically or mentally of providing for his or own care and needs the full-time attention of a caregiver. The household must be the parent's principal residence. My example for you is my personal one. My mother lived with my husband and I for a few years. When I was out on the road teaching, my husband would take my mother to the adult daycare center. The adult daycare center would make certain that my mother took her medication and fed her during the day. That was the care provided so that I could work, and my mother did live with us. Now, when I prepared our personal tax return, we had two alternatives. One was to file the Form 2441, which is Child and Dependent Care Credit. This is a credit based upon my income and the cost of my mother's care that I would receive on my personal income tax return. Or we could take this as a medical expense on Schedule A. It was for my mother's medical care. You have your tax professional work the numbers, whichever is the best way for your client or your client's caregiver or the one that maintains the home in order to claim that senior as a dependent. We know that the parent can be a medical dependent even if they are not living in your home, even if they in fact are not your dependent for federal income tax purposes. For example, if my mother was independent and lived on her own, but I took care of her medical costs, then those medical costs could go on my individual income tax return reported on Schedule A. However, I got no personal exemption, standard deduction, or additional standard deduction for that parent. All I did was be able to claim the medical deduction on my Schedule A. Now, there are some changes in medical under the Affordable Care Act. Beginning in 2013, medical to be a deductible must exceed 10% of adjusted gross income. Now, that's confusing to people who don't live in the world of taxes like I do. But let's say the interest, the dividends, the pension, the taxable Social Security received of your senior is $50,000. In 2013, in order to be a deductible medical expense, only the medical expenses exceeding 10% of that $50,000 or $5,000 would be deductible. If your senior had $8,000 worth of medical expenses, only $5,000 would be excluded and $3,000 would be able to be deducted. Unless you are age 65 or older, that's the new Affordable Care Act. If your senior is 65 and older, then they remain at a 7.5% exclusion of medical until 2016. And here are the numbers, the same $50,000 of adjusted gross income. 7.5% of that is $3,750. So if your senior, age 65, has in fact $8,000 worth of medical deductions, because their adjusted gross income threshold for medical remains at 7.5%, then they're able to deduct $1,250 more in medical than someone who is not age 65. Now, let's tell the story. This is about Beanna. In 2014, Beanna will be age 64. That means to claim any medical, it must exceed 10% of her adjusted gross income. But she turns age 65 in 2015, and now she just has to exceed 7.5% of her adjusted gross income. But at 66, she will be that age in 2016, where the Affordable Care Act applies a 10% adjusted gross income threshold to all. So even your seniors in 2016 will have to meet that 10% exclusion of medical. My question, in what year should Beanna have her facelift? Now, that clearly is 2015 because she will be able to deduct far more of her facelift cost in 2015. Now, I know if I've got a tax professional on this webinar, they're going to say, Beanna, you can't deduct it anyway because that is an elective surgery. Well, I'm here to tell you that as I have aged, I believe that old age is a disfiguring disease, and I think I can make that case in the United States Tax Court that that was correcting a medical condition. If your senior has a dependent, a qualifying child, or an individual for whom they can claim a dependency exemption, and if they're single, pay more than half the cost of maintaining his or her home, and they've had that qualifying individual for half the year in that home, they may also be able to get a favored tax status. Instead of being single, they will be taxed as head of household and save some taxes. And if this individual is your mother or your father, then the support test having been met, your parent doesn't even have to live in your house, but that's the one exception. Anyone else is going to have to live in your home for at least half the year. You do have a caution. A senior who is married filing separately and a spouse is itemizing deductions, they're going to file first. If they file first, then the spouse that is filing first determines how both spouses will file, either itemizing deductions or the standard deduction. Here's the danger in this. Tom and Beanna are separated and they are not going to file a joint return. However, Beanna's been making the house note. She's been paying the real estate taxes. She's a church-going lady, so she's got large contributions to the church. Then Beanna files her return, files before Tom does, and itemizes the deduction. Tom goes to file his return. He knows he doesn't have enough to itemize, so he files with the standard deduction. And because he is age 65 and older, he wants to take that additional standard deduction. He gets nothing because Beanna filed first and itemized. Tom is committed to itemizing. If he has nothing to itemize, he reduces his income by 0. There are some additional tax law changes having to do with the Affordable Care Act. The first one is the 0.9% additional Medicare tax, and this is on earned income. This would be for your seniors who continue to work. Instead of only having the 1.45 in Medicare taken out of their checks, once they reach $200,000 worth of earned income, any income over that will have an additional 0.9% Medicare tax on it. If they are married filing joint taxpayers, while the $200,000 applies to each taxpayer, unless the married filing joint couple's income is over $250,000, then no 0.9% will apply. There is also an additional 3.8% Medicare tax on unearned income. But I need you to understand so you can explain to your seniors. The 3.8% has nothing to do with Medicare. It is not part of earned income, so it's not going to come out of any W-2 or self-employment income. And it is not designated to pay for Medicare costs. It was just a way the government captured the 3.8% so that it would be more acceptable to taxpayers. The 3.8% is based upon interest, dividends, capital gains, rent property income, distributions from partnerships or subchapter S corporations, and a myriad of other things that if your taxpayers, single, make $200,000 or more, or in fact married, filing jointly make $250,000 or more, they may wind up paying an additional tax of 3.8% on their investment earnings. These are changes for 2013. Now, very quickly with you, I want you to understand and be comfortable with working with tax professionals. Circular 230, Federal Code of Regulations that governs how tax professionals conduct their business, has several sections that are explicit for our seniors. The first one is Section 10.21, Knowledge of a Client's Omission. The Internal Revenue Service and all tax professionals want compliant taxpayers, and oftentimes in that compliance we need to explain to our seniors that all income is taxable income unless it is exempted by statute or code. And a very good example of that would be tax-free municipal bond income. But other than that, most all other income is taxable, and oftentimes if the income they've earned is from house sitting, babysitting, mowing of lawns, not only do you have taxable income, you also have income that is subject to self-employment tax. And many seniors do not understand that. In fact, many seniors believe once they start drawing Social Security, they do not need to pay into Social Security. Diligence as to accuracy, Section 10.22. Tax professionals, all taxpayers, must be diligent in preparing a tax return, talking to the IRS, or writing to the IRS, and determining correctness of oral or written representation. The challenge for the tax professional community is the taxpayer cognizant enough to prepare the tax return, reporting all income and deductions. Your tax professionals should have a backup to your senior because they need to understand who the senior has put in charge of filing their tax returns, who has the knowledge of the senior's income and deductions so that they can work with the tax professional to prepare a complete and accurate tax return for your seniors. Section 10.27, the fees a tax professional will charge. The tax professional cannot charge an unconscionable fee. Unconscionable means that the fee must match the work that is performed by that tax professional. Oftentimes, tax professionals will not charge a senior what the work is worth. Oftentimes, a tax professional will charge more, but the CSA can run interference for the senior to say to the tax professional before the work is begun, what are you going to charge my senior? At least get a range so that you understand and ask the important question, why is your fee what it is? IRS has recently made an announcement for 2014. IRS walk-in sites will not be available for preparation of tax returns due to budget constraints. Now, there are other organizations, AARP, VITA organizations, that will prepare tax returns for low-income and seniors. So if you have a senior that has insufficient income to pay but sufficient income to file, please make certain they are aware of the resources available to them. Section 10.29, conflicting interest. That's when you're trying to represent two or more individuals. If you are doing that, the tax professional must inform all parties and get their agreement before they can continue to represent all parties. Now, who can the conflicts of interest be with? Seniors and their children, seniors and potential heirs, seniors and business partners, seniors and spouses or partners, seniors and other tax entities, and seniors and their tax professional, because oftentimes in representing a senior, that tax professional may have to also represent themselves. Several examples. I'll cover one with you. Senior wants the tax professional to determine tax implications of giving one child a Roth IRA worth $100,000 and another child, which happens to be the tax professional's client as well, a traditional IRA worth $100,000. Well, we know the traditional IRA worth $100,000 is going to have a tax implication with it, where the Roth IRA will not. The tax professional now has a compromise, and they should not have the conflict of interest. Remember, it is potential. The potential for conflict is the issue, not the conflict, and the potential for the conflict has to be recognized. Client confidentiality is also an issue for us with our taxpayers and our clients. 10.31 of Circular 230 says the tax professional cannot negotiate the taxpayer's refund, so no refund of the taxpayer can go in the hands or the bank account of the tax professional. 10.12 says the practice of law. Only a licensed attorney should give legal advice. That is a caution not only for the tax professional community, but for the CSA community as well. Now, we know in the tax professional community that a privacy policy must be established. Certified public accountants are exempted from this. But in that privacy policy, it lays out for the senior how they are going to hold the information learned in tax preparation with utmost confidence. Your example is your senior discloses the number of charitable contributions made during the preparation of the tax return. It was $10,000 and highly unusual because usually the senior only gives about $1,500. You inquire as to how much and why, and the senior says they don't even recall giving those contributions. People just called on the telephone and they were so needy that they gave them their credit card and they paid the credit card. So here we are with the privacy policy. Do we do nothing? Do we tell the client, you can't make any more contributions without calling me first? Do you call the client's children? Do you call the senior's banker? Or do you modify your privacy policy? And in this case, I believe you should modify your privacy policy. I believe a good Samaritan approach to serving seniors is warranted. I will not disclose your information to anyone unless it is in your best interest of your health and well-being. The tools you can use with your senior working with their tax return. A Form 2848 is a power of attorney. This enables the individual with that power to speak to the Internal Revenue Service on behalf of that taxpayer. A Form 8821 is nothing but an authorization to disclose, but that's very important. It says, IRS, if you ever correspond with the taxpayer regarding the tax return that was filed, send me a copy of the correspondence. The check the box on the Form 1040, which is the federal income tax return, neither gives Form 2848 or Form 8821 authorization. We need to be vigilant with our seniors. Senior financial abuse, that can come from advisors or families. Physical abuse, caregivers in the family. Emotional abuse, almost anyone who's in contact with your senior. And we need to be cognizant of that financial abuse because we can see it happen on the tax return when their interest earnings go down, when their bank account balances reduce. Why is it our problem? Because for CSAs, we care. There's no question about it. Because this could be our mother or our father, and because we are aware and do nothing would be unconscionable. They are our seniors. We need to be aware of your seniors' changing needs, work more closely with seniors to meet those changing needs, and establish and maintain your seniors' confidence and confidentiality. Working with a great tax professional only gives your senior confidence of knowing that their commitments to file their tax return with the Internal Revenue Service annually is being met by filing a complete and accurate tax return. Tax professionals and CSAs, as they serve the senior community, will bring satisfaction and pride to a lifetime of service, and finding a tax professional in the business of tax that shares your respect and desire to serve your seniors is all important. I want to thank you for joining me today. As with Erica, I apologize for the little glitch in technology, but as we are all moving towards filing our 2013 tax return beginning in less than 30 days, we know that it is important for us first to have an underlying knowledge of our tax system, and secondly, and in my case, because I'm an enrolled agent and I prepare tax returns, the most important thing you can do is have the assurance that your senior is aligned with a great tax professional who can help them navigate the maze of taxes. Oftentimes, a confusing maze, we need to leave our seniors with the confidence in knowing they fulfill their obligation to the United States government. Again, this is Beanna Whitlock, and Erica, I'll turn it back over to you.
Wonderful. Thanks so much, Beanna. And just to let everybody know, typically we usually do a Q&A at the end of these webinars. Since we are at the hour, we're going to go ahead and just take any questions through email. So if you do have any questions throughout the presentation today that you would like to get answered, please feel free to email them over to us. You can email those to society@csa.us, and we'll make sure to get them over to Beanna, and she is glad to answer those for you. And we can create a Q&A document and attach it with the documents. On that note, this presentation was recorded, and we will provide the recorded presentation as well as the PowerPoint slides to each of you when the recording is available. Please look for that probably within the next few days. We are still, if you joined us last month for November's webinar, we should have those that presentation recording up today. We were a little bit behind on that, and I apologize. Again, thanks, Beanna, for joining us today. We do have the educational webinars up on the events page of the website for January and February, so please make sure you go in and get registered for those. And we hope that everyone has a wonderful holiday, and we will see you all next year in January.